Right, so my name is Alyson MacMullan and I work with Peak Retail Group. What our group does is the science. Okay, here we go. This is not rocket science. What I'm telling you here, this is retail math. This is Retail 101. It is the first thing that they teach us. You will make money, you will make profitable money if you can figure out a way to have the right inventory in the right place at the right time and the right amount. That's what this whole entire thing here I'm going to talk to you about, because if you can do that, you will increase your cash flow. Okay, so don't forget this. If you blank out on everything else, every day you should come into your store and think about this. All right, step 2, determine the stock to sales ratio. Okay, now this may seem a little complicated, but this is the secret squirrel way to knowing how much inventory you need. So basically what this is, you can see the formula here. It's your beginning of month inventory divided by sales. All that means is with your merchandise plan you've created, with your classification and your sales forecast, every month you should be working towards your stock to sales ratio. A stock to sales ratio, if you sell, let's say your stock to sales ratio is 3.4. What that means is for every dollar you sell, you need to have $3.40 on hand to sell it. Okay? You might be asking, why do I need over 3 times as much inventory? The answer is you will never sell through at 100%. Okay. We've all heard the term open to buy, and it can be a confusing concept. But what I'm going to do is take a high level, super simple. Literally, like, this is all an open to buy is. It's a budget by month, by class that will tell you how much inventory you have, okay? Now, in this example, let's say we're going to do, in November, we forecasted our sales, and we're going to do $100,000. Let's say we've decided the right stock to sales number is 3.4, which means at the beginning of November, we need to have $340,000 on hand to sell $100,000, okay? BOM, that means beginning of month. So here's the 340, okay? We need to start with $340,000. Now, this is the fun part. Open to buy, again, is a budget by month, by classification, so you know how much you should buy and when. Now, your open to buy, your November beginning on hand is $250,000. We want to be at 340. Okay, so you would think, I need to buy $90,000 more to get myself up to this number right here. But how it works is, during the month of November, there are things that are going to reduce your inventory. Sales, markdowns, RTVs, shrink, you know, those are the big ones that reduce your sales. So during the month, you have to take away what's going to reduce your inventory. So right out of the gate, your inventory is going to be reduced by $110,000. But you have $175 on order that you're expecting to land in November. Okay, so the math here, 100, all of this is $65,000. Okay, 65 plus 250 equals 315,000. We need to be at 340. So we have to buy another 25,000 more. We need to get another $25,000 in the pipeline prior to November so that we start with 340,000. Okay, a merchandise plan. You would have seen this, you will see this in August or September. A merchandise plan will show you ahead of time, it's a roadmap. It'll show you ahead of time what this number should be so that you can take action. Because if you're sitting in the month of November, unless you happen to be going to market at, you know, at like an Atlanta market where they have a huge cash and carry area where you can plop this in, you need to plan ahead for this. Okay, so $25,000 is additionally what you need to buy to get up to your 340. So what we've done here is we've created a classification, we've created a sales forecast, And we know what our desired stock to sales is. Now you may be asking, well, how do I know what this number is right here? Okay, two things. If you've been keeping track of your sales and inventory, I would go back to last year. Look at months where you had a big, a big increase. What was your inventory like at that level? Was it a lot? Was it not a lot? Like that may be a good way to start. Your rent should not be more than 10% of your overall sales. Okay. Sometimes people have a much higher rent as a percentage, but you're going to have to make it up elsewhere because now all of a sudden your operating expenses are going to be high. I'm going to give you some other numbers here. So your rent should be about 10%. Payroll, that should be around 17-ish%. Your freight, the freight that you pay in to receive product you're ordering, should be about 3%. Yeah. Advertising should be between 3 and 4%. Okay? Of your gross, exactly. Actually, no, of your net, because your gross includes sales tax, and that's not real, those aren't real sales. So your net, okay? Now, all of the other operating expenses, those are considered operating expenses. They're all part of, a big equation. Those are the big ones. All of those added together should be between 38 and 40% of your overall business. So you can see why a retailer is not going to hit it out of the ballpark by managing their expenses because it's a smaller part of their business. What can you do? Okay, take your payroll down to 12%. Well, it just doesn't make the impact as it does with inventory, because inventory is half. Now, if you're purchasing, buyers, honestly, merchants have a tendency to sometimes overbuy. And I've seen it as high as 65% of your sales. But I'm telling you, you will never, if on average your initial markup, let's say it's 55% on average, like across your whole store, and your purchases are 65% of your total, you will never make your sales goal because you've already purchased everything at 55% IMU.